Hi, this is Mark Chandik, and welcome to the most recent edition of the Prosperity Perspective. Are you making investment decisions for the wrong reasons? Behavioral finance biases is a subfield of behavioral economics. It's the study of why investors make decisions that they make. What influences or biases do you have when making investment decisions? Behavioral finance is such an important part of investing that the SEC has staff that specifically focuses on behavioral finance. This video will talk about what psychological influences are at work when you make investment decisions. Now, it's assumed that financial decisions are made by individuals that are not completely rational and self-controlled, but rather influenced by biases. So you can consider that bias before making that decision. So let's go ahead and talk about some specific biases that are very common to all investors. The first bias is confirmation bias. Confirmation bias is when an investor has a bias towards accepting information that confirms what they already believe is true about a certain investment. So as information surfaces, the investor readily accepts the information because it confirms their particular thoughts about the investment, even if the information is flawed. For example, the 2007-2008 subprime mortgage crisis. This was an example of concentration risk in the financial sector. Specifically, banks and investors piled into subprime mortgages, and the returns were very good in the beginning. And although there were many warning signs, both professional and retail investors ignored them. There were many defaults which ended up almost collapsing the entire banking and financial world. You probably know a friend who is hot on an investment and has a large stake in that investment. And despite sharing with them contradictory information, they completely ignore you. This is an example of concentration risk and confirmation bias. The second bias is experiential bias. Experiential bias occurs when an investor's recent memory of events makes them believe that the event is more likely to occur again, also known as recency bias. For example, again, taking the 2008 financial crisis, many people lost money, and that experience biased them to prevent them from returning to the stock market. Now, the opposite is true as well. If someone experiences amazing returns and the market continues to rise, the investor experience is biased and makes them expect the stock market to never go down. Their recent experience impacts their decision-making going forward. The third bias is called loss aversion. This is when an investor places a greater emphasis on their concern of losses rather than the pleasure or benefits of market gains. In other words, they see the glass half empty. Another part to loss aversion is when someone is reluctant to sell a losing investment. Instead, they watch it go down and down. And rather than get out and admit that maybe it was a bad investment, they choose to hang on to it and ride it into the ground. This is easier for them than admitting that they made a bad financial decision or a bad investment. The last bias I want to talk about is familiarity bias. This is when investors tend to invest in only what they know or what they're comfortable with. In other words, an investor may only want to purchase U.S. domestic stocks. As a result, they're not diversified across multiple sectors, which we know can reduce risk. But again, investors tend to have a bias to invest in things that they're familiar with or they have a history with. It is a bias towards a particular investment or location of investment. Investors might stray away from foreign markets, but is that because they have done the market research, or is it because of a familiarity bias? Now that you know about 4 common biases that you may see in yourself or other close friends and family, how can that help you? Hopefully, the knowledge and recognition of those biases will allow you to better self-regulate so that you ultimately make better financial and investment decisions. I find that poor investment decisions are made and influenced by these biases when someone doesn't have a plan. In other words, if they suddenly find themselves with some investment capital, rather than having a plan that is well thought out and avoids these biases, and all you have to do is implement the plan, Again, the plan should be without biases and take out as much emotion as possible. The plan should be well diversified, avoid concentration risk, avoid confirmation bias and experiential bias. Thank you for watching. If you enjoyed the episode and want to see more, please click the like and subscribe button. Also, if you're interested in receiving a free copy of my book, please click on the link in the description of the video. Thank you for watching.